Hi traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Now in today's video, we're just going to be diving deep into autoregressive integrated moving average. All right, it's a powerful statistical tool designed for forecasting market trends. So this video will essentially explore the essentials of autoregressive integrated moving average, often referred to as ARIMA. And we're going to be revealing how it can be used to decode complex time series data for sharper market analysis. Okay. Now, beginning with the basics of ARIMA or ARIMA, at its core, ARIMA or ARIMA stands for autoregressive integrated moving average. Now, each component plays a distinct role in analyzing time series data. All right, each of them plays a distinct role in analyzing time series data. The autoregressive part suggests that current values in a data set are influenced by previous values. Okay, current values in a data set are influenced by previous values. So in practical terms, this means that past behavior can help predict future movements. It's as easy as that. All right. Now, next is the integrated component. Remember that we're talking about autoregressive integrated moving average. So we just briefly, talked about autoregressive, and then the integrated involves differentiating, or rather, it involves differencing the data to remove trends or seasonal structures, ensuring the data becomes stationary. Okay. Now, finally, the last part, which is the MA, the moving average. The moving average segment smooths out the data by averaging. The moving average segment smooths out the data by averaging out past error terms. All right. Together, these elements form a cohesive model that can adapt to the volatility inherent in market conditions. Okay. So time series forecasting using ARIMA, ARIMA, can help forecast future trends, even in turbulent markets. All right. Now, this statistical approach is indispensable, right? It's indispensable for those who aim to enhance their trading analysis and make more informed decisions. Now, let's just dive deeper into each component. Okay. Now, the autoregressive element relies on the assumption that past data has a direct influence on current values. Okay, when applied to forex trading, this means that historical exchange rates, right? When applied to forex trading, means that historical exchange rates, when analyzed correctly, can reveal underlying patterns. Now, in as much as in trading, we say that past performance does not guarantee future results, right? But that is in the aspect of performance, okay? Not necessarily in the aspect of, price movements, all right? So, considering the ARIMA, the autoregressive integrated moving average, past activity, past data, historic data has an influence on current values. Historical price activity, historical data, basically, historical data has influence on current price activity, or rather on current values. Okay, so let's use the term data and values. So the assumption, the autoregressive element of the ARIMA, right? It's when analyzed, it reveals underlying patterns, right? And it relies on the assumption. Okay, it's an assumption still, but it relies on the assumption that past data has direct influence on current values. Now, these patterns, right, they are crucial for identifying market trends that might not be immediately visible through conventional chart analysis. All right. Now, the key is to determine the appropriate number of past observations or lags to include in the model. Too few lags may oversimplify the model, while too many can complicate it unnecessarily. Now, moving on to the integrated aspect, the focus here is on stationarity. Stationarity means that the statistical properties of the data, such as the mean and variance, remain consistent over time. Many time series, especially in financial markets, are non-stationary due to trends or seasonality. Now, differencing the data, subtracting the previous observation from the current one, is a common method to achieve stationarity. Once the data is stationary, the model can more reliably capture the true underlying patterns, enabling more accurate forecasts. Okay. Now, the moving average component adds another layer of refinement. Okay, by incorporating the average of past forecast errors, the model corrects for random shocks and noise in the data. This smoothing effect is vital in Forex trading, where sudden market moves can be unpredictable. Now, the moving average part of ARIMA acts as a filter, reducing the impact of these irregular fluctuations and providing a clearer picture of the prevailing market trend. Now, consider a practical scenario in Forex trading where ARIMA can be a game changer. Suppose historical data indicates that a particular currency pair, right? Supposing historical data, right, indicates that a particular currency pair tends to follow a predictable cycle after a major economic announcement. By applying ARIMA, it is possible to model these cycles accurately, thereby forecasting future movements with greater confidence. All right. Now, this approach is especially useful during periods of high volatility where traditional methods might fall short in capturing the full dynamics of the market. Okay. Integrating ARIMA into a trading strategy begins with collecting and preparing the data. All right. Accurate historical data is essential, and ensuring that the data set is clean and properly formatted is the first step. So once the data is ready, right? Once the data is ready, the next step is to test for stationarity. Statistical tests such as augmented Dickey-Fuller test, right? Augmented Dickey-Fuller test can determine whether differencing is required, all right? So after achieving stationarity, the parameters for the AR and MA components must be carefully selected, all right? So techniques like the archaic information criterion help identify the best model parameters by balancing model complexity with goodness of fit. Okay, so once the model is constructed, it is time to validate its performance, and backtesting the ARIMA model against historical data will reveal its strengths and potential limitations. Okay, adjustments can be made based on performance metrics to enhance the model's predictive power. Okay, the ultimate goal is to achieve a balance where the model provides reliable forecasts while adapting to the ever-changing market conditions. So embracing ARIMA can elevate market analysis by providing insights that go beyond surface level trends. The statistical rigor of the model adds depth to the analysis, offering a more comprehensive view of market dynamics. So whether it is used as a standalone tool or in combination with other technical indicators, autoregressive integrated moving average stands out as a robust method for forecasting and analysis. So as the trading landscape evolves, continuous learning and adaptation are key. Regularly reviewing and refining the ARIMA model is crucial to ensure it remains aligned with current market conditions. And the process of continuous improvement helps in identifying subtle shifts in market behavior that might otherwise go unnoticed. Before wrapping up, it is important to highlight the versatility of autoregressive integrated moving average. While originally developed for statistical analysis, its application in the trading world are extensive. Okay, ARIMA is not just a theoretical tool, but a practical solution that empowers traders to make more informed decisions based on solid quantitative analysis. All right. Now, if the insights shared in this video add value to your trading strategy, please hit the like button and subscribe for more expert insights into Forex trading, advanced forecasting, and market analysis. Your support is vital in building a community of informed traders. Thank you for watching. Stay analytical, stay strategic, and keep refining your approach to market forecasting. I hope to see you in the next video.